All right. Access to this webinar is educational and informational purposes only. Consult a licensed broker, registered investment advisor before placing any trades. All securities and orders are discussed and tracked. Are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockworld.com, PSW, nor its affiliates or any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker dealers. Nothing contained in this webinar website or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not applying or guaranteeing any profit. As always, do not trade with money you cannot afford to lose. Past performance does not equal future results, and the results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mail list to receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anybody. All right, let's get this show on the road. I feel better, obviously. I'm still coughing once in a while, but I generally am better. Certainly feel fine. Just every once in a while, I think it's triggered by things I eat that makes me cough. I noticed that I had this morning. I had coffee, you know, with a latte coffee, and that seemed to be bad for me. I don't drink coffee every day, so it's just the first time I drank coffee in a while. And I started coughing right after I had the coffee. And what else did I have? I had toast. All I had was toast and jam. So I don't think it was a toast. I think it was a coffee. Or the milk. Maybe it was the milk. But I don't know why that would be annoying me. Anywho, so we'll recover now at the moment. We're waiting on the Fed, of course. 2 o'clock, we get some Fed speak, Fed decision in 55 minutes. And I did a radio spot yesterday on the Hemboka show. I'll be doing that. We own Hemboka. PSW Investments owns Hemboka. So it's a self-promotional thing, basically. They have the worst ad, though. The radio station put together an ad for us, and I didn't know how horrible it was until I saw it yesterday. So I got to change that. Anybody who's into advertising and stuff who wants to help, I would appreciate it. Because I thought they would do a good job, but they did a terrible job with the ad. They did a nice ad for Hemboka, nice video, everything, beautiful ad. But then for us, it's like garbage. It's like it's not even a radio spot. It's awful. So anyway, but bottom line is, on the Hemboka show, what we were talking about was the basics, because it's the first time I've talked to their audience. And, you know, we're talking about like what you can do with an ordinary portfolio and getting back to the core philosophy. And look, and I've been saying the last few days, in fact, we, I don't know why we're on the Money Talk portfolio review. Yesterday I did the consolidation yesterday, which takes me time to get around to, of the portfolio review. It's just to say all the portfolio reviews are me making a few notes and then just the same reviews. There's a link to the original thing. See from the fourth one. Well, I don't know if you can see on my screen. And in this part of the screen here, you see it pop up. It says 417. So that's the original comment where the short-term portfolio review was. All I'm doing is consolidating those comments in one spot. It was tricky this week, though, because 2 times we actually made these things in a post. So I had to link back to the original post. Like the Money Talk portfolio I did a post on, and the Options Opportunity portfolio I did a post on. Anyway, so what I was saying here, though, was, I mean, come on, it's ridiculous. And guys, I've said this before and I've been right. You know, and maybe I've said it before, I've been wrong. I said, but I got to go with my gut. You know, when push comes to shove, there's no way to know for sure. You know, and all things being equal, you know, if you're a good trader or a good fund manager, you just got to go with your gut sometimes. And my gut's telling me I don't like what's going on. And I know everything seems great. And if we have the China trade deal, I guess I'm going to hold off and see how high we go after the China deal. But how are we going to bust through S&P 3000 without a pullback? That's the wrong place. Where's my Finviz charts? There. Oh, here you go. Great. S&P. So here's a weekly view of the S&P. So, okay, 2014, 1800. 2015, 2000, 2016, 2000, 2017, 2200, getting up to 2200 at the end of 2016. This is, you know, what's 2 into 16 is 15, coal is 15%. This is 12%. So 15, basically 15% in a couple of years is normal. 8% a year is normal, right? So year 1, year 2, year 3, year 4, year 5. So at the end of year 5, 40% higher. Okay, 1600 plus 40% is 2400. That's actually normal market growth. 24 is up here. That's actually normal market historical growth, 8% a year. You can't say that's unearned. That's the way the market has grown forever. So one thing is scaling, because here we are 1, 2, 3, 4 years later. So another 30%. 30% of 2400 is 800, brings you up to 3200. So it's not unprecedented. In fact, it's quite normal. As weird as this looks, this is what happens when you grow 8% a year and compound it. So this is just normal, healthy market growth, what's going on now. But when you're in the top end of the range, you don't want to go long. You expect a pullback. It doesn't grow in a straight line. So here you have, in fact, an example of 10 years, 5 years. Oh, you know what? I've been doing my years too soon. I apologize. Stupid me. I'm looking at halves and calling them years. It's really only 5 years. It's 5 years. So 40%, I'm sorry, 2200, 1800 plus, well, let's do the right math. We're going to discuss it. We should discuss it with the correct numbers. All right, so 1800 times 1.4 is 2520. So let's say 2600 would be normal growth. Anything above that, which is we're another 15% higher than that, that's abnormal growth. We're basically 2 years ahead of what you would expect in growth. So I think that's the way to look at it, is we're 2 years ahead of what we'd expect in normal growth. And that's a lot. Okay, it's a big standard deviation. It's a lot, and it's in 5 years. So it means we're 40% ahead of where we should be. 2 years, more than 5 years, is 40% ahead of where we should be. So it's way off the charts. We got there last year. We pulled back drastically. Okay, we got here now. I think 3,000's got to be resistance. You had a run from 2,400, so the 5% rule is telling us that at 3,000, and by the way, 24, good consolidation. That means your next big number is going to be 32. 36. So 36 is the real tippy top up here, is a 50% gain from there. So that's what we're going to be looking for ultimately. But on the way up, 18, and a 50% gain from 18 is add 9 is 27. So here's your zone for 1800. Where do we have our big consolidations? 1800 consolidation, 2200 consolidation is on the way. So somewhere around, and really I think 2150 is a number we were using back here, was our must hold line for a while. So if we look at 2150, 2150 times 1.4, 3,000. So either way, we're in the, you know, this range from 3,000 to 3,600 is the top of the new range if we get there. But I don't see how we get there from 24 when that's a 25% run. 24,000 to 3,000 is a 25% run without a pullback. And your pullback off a 25% run is 5%. 20% of the run is your pullback on the 5% rule. So if you're going to fall 5% from here, that's going to be 150 points. That's going to take you back to 2850. And that's a weak retracement. A strong retracement is going to take you down another 150 points back to the magic 2700 line. And that would be great. That would be nice, healthy. I'd even possibly, and we'd be back on the track of gaining 8% a year like a normal market. All right, so that would make sense. And that would be a logical pullback, and I hope we get that. So the trick about the portfolios is managing them and saying, well, okay, so how badly damaged are we? We don't think it's gonna really pull back much more than that. I think we're generally healthy. We did that thing of the NASDAQ. I forget when, but I looked over the whole NASDAQ and we reviewed all the all the big ones anyway. And well, that's a good idea. Well, now that we've had earnings, let's see what happened. Let's see what I actually said and how they did. Oh, I like that. All right, let's see if we have a question before I do that. But that's an interesting side turn on the thing. Nobody has any questions? So good. Okay, unless nobody can hear me and the thing's off, but I'm not going to worry about that. Where did I do this? I know I reviewed the NASDAQ earnings season. Money talk. Beats keep coming. Trump. Blah, blah. Wait a minute. I know I did this. I was just going to give up. All right. So we graded all the NASDAQ stocks and said, can we actually hold, is 8,000 justified on the NASDAQ? To my surprise, I asked this question. You guys got to realize I'm doing this like 5 o'clock in the morning. I'm looking. My process is generally I'll sit there and read the news. When I wake up, I read the news. I'll put up some stuff I think is interesting, and out of all the stuff I read in the morning, I decide what I think is important to talk about that day. Sometimes it's politics, sometimes it's the news, sometimes it's nothing that important, and I just talk about the indexes, the levels, so on and so forth. On that day, which was Wednesday a couple of weeks ago, we talked about the NASDAQ. I think I did go over this in that webinar, so I'm not going to spend too much time. But bottom line is the top 10 stocks, and it's only 9 because Google's here twice. You got Alphabet. So the top 9 stocks are 40% of the index, which means the other 2,629 stocks are really not important. It only really matters what these stocks do. And look, with Pepsi, you're already down to 1.49. So I mean, look at the weighting here: Microsoft, Apple, Amazon, Alphabet twice, so it's more in that category in the high. And the Alphabet's really in the top 4 there. Facebook bringing up the rear. Intel took a hit, but all right, we'll get to that in a second. All right. So, once you get down here, they're almost in the also rans. But but obviously you've got stocks at 0.0 blah blah % down on the bottom. So none of that matters much except for what's going on with the big guys. Now, I gave grades, and I said here Microsoft B-, okay, and they actually came in with great earnings. Apple, I gave a why did I give them a C? I guess you can say Apple's undervalued, but even though I worry about paying 20 times for an electronic manufacturer, which is subject to market cycles, So Apple gets a C for justifying the gains, but I'll add a plus. I don't see any reason they should correct much from here. Now, I don't know where here was on that day. What day is this? How do I find out what the actual date is? April 17th. Okay, so on that day, April 17th, around here, so 200. Now, as it turned out, going into yesterday, we were very, very super aggressive in the hedge fund with Apple. We had 100 longs and only 40 shorts. And now we have, so now we bumped it up to 80 shorts. We basically, I'm satisfied with this. Obviously it can go higher, but I don't want to risk it. It's like we made tremendous gains because we were aggressively long, and we just made $15 times 100 contracts, which is what, $150,000 today. I locked it in. I don't want to make $150,000 today and lose $150,000 tomorrow. I don't like that. I want to. If you make that kind of money, you say, "Great, we had a great month." That right there is a great month. So we lock in the gain, and now we move forward. And plus, also locking in the gain because we're selling calls to lock in the gain puts money in our pocket that we can then. So lessens our need to hedge Apple. So for many reasons. But anyway, so Apple actually did, okay, so bottom line, Microsoft actually did better than the B- I gave them. Apple better than the C+ I gave them. Amazon definitely better than whatever I gave them. They are B- and they're actually great. And see this 90 times earnings, it's not 90 times earnings anymore. It's more like 50 times earnings. Their earnings are coming up nicely. Google, huge disappointment. And I messed them up. Google has been on a tear. The profits are up, blah, 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 good steady growth. All this is out the window because they didn't grow. They contracted. Profits went down. And I gave them an A, and they actually went. Are they still justified? I think they're. I'm actually, we're going to buy them. If they come back down a little bit further, we're going to actually start buying Google. This is finally a more reasonable price for them. I would love to get them down here in the 1100, 110.50 range would be fantastic to start picking up Google. But they certainly disappointed. Facebook, I don't even know how Facebook did. I got to tell you. What did Facebook have earnings yet? If they did, they weren't exciting. Yeah, I guess they did. Okay, so Facebook had their earnings. I totally forgot what they were. Shit. All right. Let's see if we can find it. Facebook. All right, they had earnings on the 24th. Pressure on profit margins, crushed earnings again. Yeah. Okay, so on the 24th, and what was the reaction to Facebook's earnings? Oh, they popped up like significantly. Okay, I for some reason I blanked on Facebook. What were we just talking about? Yeah. All right, so Facebook, I gave them an A+, and they obviously performed as expected for that. Google again, and that really hurt. That was a bad, nasty fall. Look at Intel's fall also. We'll get, okay, so now we're at Intel. I called Intel an A. Okay, because they have the data centers and they're done with the modem production. But Jesus, they had a huge miss and people were bailing on them. I'm going to be loving them if they can get down to this zone. I'm a buyer for sure. Okay, but again, they didn't make their grade. But so far, the ones I graded, the ones I graded high have gone down. The ones I graded low have gone up. So it balances. That's the key to that, though. We're still justifying the Nasdaq at 8,000. Cisco's another one. I have no idea if they've even had earnings yet. Funny how these used to be such important companies, and now it's like, Cisco. May 15th, that's why. Okay, so no, we're waiting on Cisco's earnings. I gave Cisco a D. I don't know how they're performing since then, but I did not like the way they're structured right now. And it's a D as in does Cisco justify the NASDAQ being as high as it is? And I say no, I think this is too high for Cisco, and I think there's weakness there, and it's going to lead to problems down the road. Comcast, I gave a B+. They've been flying since then. I don't know if they had earnings yet either. CMCSA. I mean, Disney knocked it out of the park. No, they did report earnings, and obviously they went okay. Take a look at how their reaction was. CMCSA. Yes, they had a nice little pop on earnings. Oops. And I gave them a B-, so they were okay. I said, look, it's 16 is not outrageous for them, so it was fair, and obviously they justified it. And then Pepsi. And again, Pepsi, it's funny, I don't actually pay attention to these things once they go out. Pepsi had their earnings already, and I've paid no attention to what they were. I think they were right. Yeah, Pepsi popped up nicely on their earnings. So I gave them a B at the time. So, you know, and again, this is in the theme of that automation thing where I've been saying that, you know, the thing is, you know, we're chugging along and improving, and corporate profits are improving, but that's very much to the case, and you can see it from stagnant wages. You know, we're not hiring more workers, we're just making more stuff. Companies are getting more efficient in lots of ways. AI, or not really AI, but the, you know, way smarter computers, doesn't matter how you think of it, but to the smarter computers to the point where they're practically intelligent. That's where we are now. And whether you call it artificial intelligence or whether it's just an incredibly well-written program, you know, coding has gotten to the point now where, you know, inventory controls are incredibly efficient. Shipping is incredibly efficient. Amazon is now telling you can get stuff in one day. They will ship you most of their stuff the day after you order it, and it's happened to me too. In fact, I just ordered iced tea on the weekend, and I think I ordered like Saturday night, and Monday morning I had the iced tea it came in the morning. And it's ridiculous. I don't actually need it that quickly, but you know, it's just weird, and it certainly does make me go to the. I mean, I certainly don't go to the mall. And Tina's been like that for years. I mean, Tina stopped going to the mall years ago. She orders everything online. I still like to actually. Well, I like to go to the mall because I like to see what's busy and what's not busy and who's buying what and what's being sold. I don't go to I go to the mall for like research. I'm not going to the mall so much for shopping. I mean, I just like walking around. I like walking downtowns, districts, and things like that. I like to see stuff. But the need to go, I mean, I can see where they're in big trouble. And the mall I go to the most, so I guess I'm a typical consumer, because the mall I go to the most down in Florida is the Bal Harbour Mall in Miami, which is far. It's like an hour from me. But they have a kick-ass sushi restaurant that has incredibly good Kobe beef. So pretty much once a month I go to that mall. I go to that mall. I've been to the Boca Raton Mall, which is the closest big mall to me, twice in a year. And I've been to the Bal Harbour Mall about 5 times. So, you know, so that's the strategy of like turning malls into like event spaces where there's things going on and really good restaurants and entertainment. That's going to be the future, because the shopping, not so much. You know, I mean, people more and more are just able to order this stuff. We have those Amazon, everyone's got those Amazon boxes now where you, lockers, they're called lockers, and you pick up your stuff at the locker. I don't like it. I like it better when they put it on your doorstep, but apparently it cuts down theft and all that. But it's easy though. It's really, they text you to your phone and says you have something in the locker, go pick it up. So when you're going past the locker, you just go bip, 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 and you punch in the locker and it opens up for you. So it's kind of cool. Oh, and what's really cool about those is if you have three things, if you put in any one of your numbers, all three open up at once. So that's kind of fun. Now we have a cleaner that set up a locker. So now we just put it's very smart. There's a cleaner down here next to the Amazon locker. They've got their own locker, and you put your clothes in the locker, punch in your code, they pick it up, send you a code back, and when your stuff is ready. So they deliver the stuff back to the locker, and you just pick up. So you put in dirty clothes, pull out clean clothes. It's really fun. That's what's happening across, like, again, it's a freaking dry cleaner, but this is what's going on in the world now, because the apps are there for people to track every little thing that happens, and it's easy for them, or relatively easy for them, to keep track of clothes, and to inventory controls are easy enough where they take the clothes, they put it in a bag, they barcode the bag goes through the cleaning, it comes back, it's barcoded back, and it goes back to your locker, and it's a system that's good enough where they're not worried about losing your stuff. In the old days, they don't take responsibility like that. Look how many things could go wrong. These days, you can do that kind of stuff and nothing goes wrong. And that's efficiency. Even this little cleaning story, it's efficiency caused by automation. And it allows them to service via delivery all these people. Down in Delray Beach, where I live now, we have a thing called Delivery Dudes, okay? And they are just like Grubhub or just like DoorDash and all these other guys, super efficient. I mean, these guys are really, totally on the ball. And I don't know exactly what their deal is, but they apparently have a deal with almost every restaurant in town. There's almost nobody who doesn't have Delivery Dudes. Like Grubhub is haphazard, and DoorDash is haphazard, but Delivery Dudes, I can't name a place that doesn't have delivery that you can't get from Delivery Dudes. They seem to go everywhere. Maybe they don't. Maybe the way they set themselves up, they don't have to have an agreement with the restaurant. They just deal with the orders. But whatever the case, I was at their place, Mike, because we're possibly making a deal with them to do our CBD products, and to deliver them, which would be kind of cool. And their place it's a bunch of young guys, 30s, and they had this idea in college 10 years ago, and they've been developing, and now they have a huge delivery service all over South Florida, and they're basically they're like a Silicon Valley startup. I mean, they're just a bunch of young guys hanging out in the house having a good time. They've got pinball machines and ping pong tables and foosball tables and things like that in the office. It's really just, and the whole thing is all about having a really good software system that makes everything work very simply. And I sat there with them and I was talking to them, watching their customer support and things like that. They only have a few people on customer support. It generally goes flawlessly. They train their drivers well. And the drivers are gig workers. So, the company is such low overhead. It's just an incredible gold mine they've got going on there. So in the economy, it's just efficiency. It's unfortunately, though, the least important part of these operations is the freaking workers. They're just replaceable little cogs in the machine that eventually will be replaced by robots. In fact, I just saw today, I think Washington State, I believe, in Seattle and stuff, is going to allow automated robots, little boxy things with wheels, are going to deliver things in Seattle now. They're going to just go independently, just go up now. Like rolling out this year, things are going to be delivered by robots coming to your door and going beep, beep, and telling you to open the door, whatever the hell they do. And it'll become normal very shortly for you to be walking down the street next to robots. And that's the crazy world we're living in now. So but that's why you kind of have to accept the fact that these companies, as I said, like, we look at these NASDAQ stocks. Now that we've got most of these earnings in, they're fairly balanced. And they are essentially worth what they said they were worth. We're at NASDAQ 8,000, and that's not an incorrect spot, really. I think we're going to be subject to some contraction and a correction, but not a correction like we're going to drop 20%, a correction like we dropped 10% to consolidate, and then we drift along the 8,000 mark for a while. And then as time goes on, we go up another 8%, but now 8%, don't forget, is going to take us to 88,000. It's every 10% now is going to take us to 9,000, 10,000, 11,000. You're talking about in 5 years. You're talking about NASDAQ 11,000. That's up 40% from where we are now. That's going to be normal. And it's not going to be that hard to make money. So unless the economy collapses, which I don't really see happening at the moment, the most likely thing to blow up the economy is debt, which we're going to hear from the Fed in a half hour. But without the economy collapsing, without some really horrible thing happening, and I can't even imagine what could be horrible. We have a president who's probably going to be impeached, or at least going through like the kind of crap Bill Clinton and Hillary Clinton went through with the Benghazi and everything. It's going to be, they're going to basically be an investigation. It'll be like Benghazi. It'll be like Trump is going to be under investigation for the next 2 years, and people around Trump will be under investigation for the next 2 years. We're going to have a completely dysfunctional government, but the market doesn't care. They don't care about that. They don't care that Russians are interfering with our elections. They don't care about what's going on in Venezuela. They don't care about what's going on in Iran or Iraq. Nothing seems to matter. And China's just humming along. China's markets are doing better than our markets this year. So what's going to derail things? Europe obviously has their own mess, but their mess is mostly a self-inflicted wound. This Brexit thing it's like they can't sit down and work it out. They can't all sit down at the table and figure this thing out. It's not, come on. You're getting divorced. People get divorced. That's what you need to do, is call some American divorce attorneys. They know how to do this stuff. Just get the thing done. Whoever did Steve Wynn, that's the guy you want to get. Not the guy who did Bezos, because that dude lost a lot of money. Get Steve Wynn's guy. He was good. So work out. Just work it out and get the thing done and be done with it and move on. That's what Europe has to do, but that's not something you short the market over. And they talk about a hard Brexit, this or that. All it does is affect the UK economy, which is all right. I give up. I'm going to say $2.5 trillion. UK GDP. Oh, I'm so good. All right, $2.5 trillion. So all it's going to do is affect the UK economy, and even if the UK economy is affected by 10%, which would be crazy, that's $260 billion. $260 billion is like a rounding error on our defense spending. So it's not going to blow up the world. People make too much of these things. So, on the whole, you just got to look at the health of the companies and say, look, there's not really much going to derail this thing. And again, my wishes to cash out is just because I don't like having this kind of gain at risk. I feel more comfortable, cashing out and going to smaller portfolios because we play pretty aggressively. And so, when you make a lot of cash, it's good to take it off the table. And this goes to anybody who's made a lot of money this year. If you have a goal, you have $1 million, and your goal was to make $100,000 a year trading stocks towards your retirement in 15 years, let's say. So you got $2.5 million when you retire at least. If now, today, you have $1.5 million because you went up 50% in a year or less than a year or whatever. Okay, so if you have $1.5 million, you gain 5 years ahead of your goal. You're 5 years ahead of schedule. Why risk it? Okay, the best thing to do is to take that $500,000, put it into something safe and secure, not that gets no interest, but and you can even be in the market, but it's in nice conservative trades. They're going to make a nice 10%, whatever. Because if your $500,000 moves into something very, very safe that makes 10%, and I'm talking like buying AT&T and selling calls or something like that. So you collect the 6% dividend from AT&T plus you sell the calls, you're gonna be way over 10% a year. So something simple and safe and secure like that, where you're gonna be pulling in $50,000 a year, that's half of the $100,000 goal that you had for the next 15 years, is now locked in by the $500,000 you made and put to the side. And now your risk of even a total wipe out of your portfolio only puts you back to the million you started with. Doesn't that make sense? Wouldn't you rather have a situation where you're safe and you're sure that you're going to make money and you're sure you're going to do well, rather than risking $1.5 million where a 50% wipeout could be, bring you back to the 750 and then you're behind. Now it's 2-3 years later, just like we did in 2009, right? 2010, 2011, 3-4 years after the crash, we were still way behind, most of us. And when you're retiring in 15 years, you can't afford to go 3 or 4 years behind. So when you're 5 years ahead, lock it in. You don't know what's going to happen tomorrow. You never know. And by the way, if the market keeps rocketing higher, you got your $500,000 making 10%, and you still got your $1 million making the same stupid 50% you just made this year. You're not missing out on much, even if it goes up. So, that's how I feel about these portfolios. They've made too much money to leave on the table. And I don't like that. I would rather play logically and safely. And it's so easy to take money and make money. And again, that's what I was saying on the radio show yesterday. It's not hard at all. And I will talk about a couple of those in a minute. Let me see if we have any questions. No questions. Would you adjust our Disney position at all? Brandon is asking. Currently, we have 25 and 10 short 100 puts. Do we? See, you say our Disney position, so I'm going to have to now figure out what portfolio that might be in. And meanwhile, I want to make sure we didn't. In the long-term portfolio, thank you, that's helpful. Let's save me some time. Control F DIS, and of course this is a pointless, but we don't need the margin, at least not in the least bit worried, so we'll wait out our last 540. That must be a short put. That's a short put in the short-term portfolio. And here is what is this? Long-term portfolio, okay. So last time I said we'll roll the short April 115s to the June 125s at 9, and our 110, 140 is only 42,000 out of 75,000. So you said we have the short 100s. Wait, what? We'll roll the short April 115s to the June 125s, and I guess we already have the puts. Okay, so let's see what we have. I don't think that's not going to be reflected in this portfolio yet, but let's take a look. because I didn't get all the changes done yet, I don't think. Chugging along. Disney. Oh, no, I guess we did do that. This is June 125. Haha, we did that one already. All right. So what Brendan's saying is, would we adjust it, basically? So here's the thing. Disney's at 137. Our target is 140. Seems like we're on target. Not sure that's something I would adjust, but let's take a look. That's the Fed. There it is. Whoosh. I mean, to me, that's a bit over. It's overdone for the run now. It's way extended. The position, though, is we have the 95 puts. Those are now useless, so we should buy those back because they're wasting space. You know, for 670, although it's obviously not going to come in, we don't really need the margin, but just when they have a pullback, I'd like to sell some puts. So I would rather clear for 650. I'd rather clear the deck. The spread, the 110, 140 spread, I'm happy with that. 125, I still think is a realistic target, so I don't think I would change that. We sold them for 10, and now 13. They're covering the gains that we've made. So I don't have any reason to really change that either. It's not even a full cover. It's only a 15 out of 25 cover. So 40%, no, 60% cover. So no, I wouldn't change this because it's basically fine. I would buy back the puts. You got the 110, 140 spread. The potential for the spread is $75,000. And the current net of the spread is 86,750 minus 43, 250 minus 2025. Wait, no, 20025. 025. So it's only $23,000 net on a and minus 675. So it's only $23,000 net on a $75,000 spread. That's basically out the money. So change it. It's a good for a new trade. It's gonna make 200% from where it is now. It's properly hedged, and it's a fantastic spread. And it's a hell of a lot safer now than it was originally. The funny thing is, though, originally we only paid 38,750 minus 23,750 minus 15,123 minus 8,000. We sold those puts for. This was an $8,000 credit when we started. So we have an $8,000 credit spread that's going to pay us $75,000 freaking dollars, and it's already, you know, whatever I said it was, $25,000. So it's already up $30-something thousand, and it's only just getting started. So, and I understand because I'm sure you know, you're looking at the portfolio that's probably saying to you, you know, holy crap, you made a lot of money. And again, this is what I'm talking about. These gains are surreal because this is a 2-year play. This isn't a 1-year play. You know, we started this thing back. This is 122.19. Oh, we started here. I mean, I'm sure we've adjusted this thing along the way, but you know, we started this trade a while ago, whatever. But this is a trade we expected for 2 years to be waiting to get to this level, and it's already there. And that's what I mean when the markets are unrealistic. It's like, this is, I love Disney. I think it's a great company, but this is too fast. But on the other hand, they just released, and it's still playing right now, they just released days ago the most successful movie of all time. And it made $1.2 billion in the opening weekend. It's probably going to finish around $3 billion. Okay, so let's put that in perspective and look at Disney. Okay. Financials. Okay, total revenue, $50-60 billion. So that's adding 5% to their total revenue. One movie adds 5% to their revenue. And obviously, even as ambitious as you think this movie is and whatever, they certainly didn't go in the boardroom and say, we project a multi-billion-dollar movie. So I will tell you for sure that the cost of this movie and their break even is well below $1 billion. Nobody's making a movie that doesn't break even at $1 billion. That would be kooky. If you need $1 billion to break even, you really got to get your costs under control. So everything over $1 billion is gravy for Disney, and that's more important when you look down and say how much is this going to affect their operating income of $13 billion. And now we're talking about adding not 5%, but probably drop 10% to the bottom line. Okay, so that's blowing past projections. Nobody was projecting that they would make $15+ billion this year. Not only that, though, but in fact, we were noticing when we were at the theater watching, when I was paying my money to watch the Avengers this weekend, we noticed that almost every month this year coming out, because they had like posters for all the movies that are coming, and we noticed that like almost every single month there is a Disney movie coming out. And that's because Disney now owns Fox and everything. So you're talking about for the Star Wars movie, of course. They're making another Maleficent, and they're not obviously going to be billion-dollar movies, but it's these are big movies. Star Wars is going to be a billion-dollar movie. I forget, but more stuff. I mean, anyways, like another Toy Story is coming out. That could be a billion-dollar movie. It's just not, although I can't even, I gotta tell you, I saw the previews of Toy Story. I'm like, I don't know about this one. Like a spork is the star of this one. I think they ran out of ideas. But who knows, maybe he's adorable. It's like the gingerbread man in Shrek. Like, who would have thought that was gonna be cool? Anyhow, so where were we? Oh yeah, so you got all that going on in Disney. You also have, and this is what people don't understand about Disney, is that Disney's huge R&D company, huge. They don't call it R&D, but obviously, I call it R&D when you're making a film and working on projects and spending unbelievable amounts of money. Disney, in every animated movie that they make, their goal is to perfect one more thing. Like in Rapunzel, they're doing a story and they're doing a movie, but their goal was to perfect hair. And that was the point of Rapunzel for the animators, for the CGI guys and the animators. Their goal in Rapunzel wasn't to make a movie about Rapunzel. Their goal was really to make a movie where they perfect hair and the motion of hair on their characters. In Frozen, it was snow. They were actually their goal in that movie was to perfect snow and snow scenes and so on and so forth. And that's what they do. Every movie, they set a goal and say, we are going to make the best ever this. Moana was water. They seek to perfect some aspect of animation that they will then use in other things. And by the way, all that stuff comes together in like the Jungle Book, which I don't know if you guys saw it was animated, but it was unbelievable. It was like, it was animated except that it kind of looked almost real. It was like, it was all CGI things, but it just looked real. It was beautiful. The jungle was beautiful. Everything was gorgeous. It was amazing. So anyway, so that's R&D. They didn't need to spend the extra $50 million on hair that they spent in Rapunzel, but they have the movie that justifies the spending of the money that they then are able to use every movie after that. And they know there's going to be a lot of movies after that. So the program that runs hair, the CGI programs that run hair, are an asset to the company. These are undeclared assets that Disney has that are unbelievably valuable. And it allows them, and you see it this year, month after month after month, they're cranking out a movie every month. And if you look at the money they can generate off of these movies, you got to figure, for them, 100 million is a flop for Disney. Like Dumbo did 100 million as a flop. They're talking about, they put out 12 movies, probably going to average at least 200 million. You're talking about $2.5 billion worth of movies at least. If they have one blockbuster, it picks up to $3.5 billion, $4 billion in movies. Now they're opening R&D again. They built the Star Wars theme park. How is that not considered R&D? How is that not considered the asset? But they don't consider it that way. They just call it park expenses. And they build an entire hotel, which has value, and they sell timeshares in the hotel that has value. Like I have Disney timeshares. I've had them for 20-something years now. Love it. Friggin', it's great. But those properties that all around the park are half-sold timeshares. And it's on points. And it's not like you get a week or something like that, but it's some point weird deal that you trade in your points for time, whatever. It's a good deal, though. I like it. So these things all start clicking in, and it's more and more and more. Now you've got these 2 Star Wars parks with Star Wars hotels that are going to attract more people, and they raise their prices to like $125 a day for tickets, which is a 25% bump. And then, of course, they got the TV revenues coming in. They just merged with Fox. They're going to add, so these revenue numbers are going to start skyrocketing because now they got the Fox money too coming in. I don't see how, and you can buy the whole company for $250 billion. And last year they made $13 billion. That's 20 times earnings, and these earnings are going to fly. Let's see what the analyst says. Analysts say 650. They're see, the analysts are not projecting a higher earnings. They are going to blow this number away. This is wrong. And even if it wasn't wrong, though, they're making a freaking fortune. It's a fantastic company. So yeah, I would keep it. That's my answer. I would keep it. All right, 4 minutes to the Fed. Hey, that was good timing. All right, what else is going on here? And look, that goes for a lot of these positions. And we did the portfolio review. Where's that portfolio review? I certainly don't have time for this. 3 minutes and 48 seconds to the Fed. All right. Look at this song is gone. Oops, so now I said it. Now it's echoing in the back of my head again. So what was I looking here for? Oh, right. Okay. So look, when we do these portfolio reviews, and the long-term portfolio is not a good example, but in the money talk portfolio, for example, and it's not that I don't pay attention, but I'm, but the money talk is small, and it's like I have time to go over it. But we talk about, where is it? Money talk, here you go. Okay. So, look, for our positions, you always look at a position and say, well, how much are you in for? How much is it and how much is left to gain? And how sure are you you're going to make that money? So Alaska Airlines is at 60. We sold the $60 puts. We're not worried about them. So we're going to make 40, we have $2,650 left to gain on Alaska Airlines. On these hedges, we expect to lose the money because if the market goes up, we lose. Caterpillar is trudging along. We expect to make $7,000 there. So we've got $7,000. We're going to make $7,000. It's 100%. Do I have something? Now, we're going to make 100% on Caterpillar at 130. It's at 142 now. So this spread right here for $7,000, we'll make another $7,000. We'll make 100% if Caterpillar doesn't go down $12. So what should I do with that spread? How sure am I? So if I feel comfortable Caterpillar is not going to fall 10% in the next 2 years, this is 100% moneymaker. How easy is that decision at that point? Every position should be like that. You should do the math. So we go back to that when we were just talking about Disney. That's going to make 200% in 2 years if it basically just stays flat. My confidence in that is very, very high. My worry of losing money on Disney, very, very low. End of story. That's it. You've got to know your positions and understand what they're doing for you. And they're either going to be worth it or not worth it to hold on to. All right, should we read the Fed thing? Yeah, it's short, so we're going to read this one. FOMC statement. Here are the prior statements for reference. The Federal Reserve. That's not it. Here, it's going to come out here. Anyway, I'm going to put on the volume of the TV though, because they're going to be faster than we are. Whoop. All right, and let's see how the market's looking. Kind of steadies, 29.50 right here where we were shorting before. Here it comes. No change. Patient. The Fed has broadened its concern of inflation being below target. That's bullish. Nothing, so nothing. So on the whole, nothing happened. Here we go. All right. Quiet. There you go. All right. Okay. Labor market remains strong. Economic activity solid rate. Job gains have been solid. Unemployment rate is low. Growth of household spending and business fixes slowed in the first quarter. I'm very concerned about debt. Household spending is going up and income is staying flat. And that's just more debt when you see that. And that's not good. I think that's where you run into problems. That's where you ran into a big problem in 2007. And it's actually way worse now than it was then, like by a wide margin. There's so much debt on people's books. And part of that is caused by a kind of irrational exuberance. People think the economy is better than it is because they're being constantly told how great the economy is by their president and whatever. And and they ignore the facts, or they think it's getting better, or they promise crap, like the farmers get promised stuff. And so based on Trump going out and saying, we're taking care of you and don't worry about this and that, and they go out and buy the equipment that they need to buy, even though there's no actual money, because they're like, oh, Trump's going to send us money. Now he said he's not sending money. All of a sudden, he just went back on his word for the farmers. So people spend money they don't have because they think they're going to get something. People spent a lot of money thinking they were going to get these great tax refunds this year. Didn't really happen. That shock or that realization takes a while to kick in, but what it does is by the time next year rolls around, people start ratcheting back their spending. So, that's why these things don't seem to have an immediate effect, but over the long haul, it gets very dangerous when you have a situation where you've got people spending ahead of themselves, and if the money they think is coming doesn't come in, they just end up with a whole lot of debt they can't really afford. So the Fed says on a 12-month basis, overall inflation for items other than food and energy. And I love that because you gotta love the Fed, because if you look at energy on a daily basis, this is what's happened to people. So other than the 50% rise in the price of gasoline, and other than the 20-something% rise in oil, everything's so hunky-dory. Nope, that's not it. Let's replace that. Let's see if we can get one of those. I'll leave those ones where they compare them side by side. So, such nonsense. And food, of course, is food. Food's not so bad, but energy is really bad. People get killed. It's like back to $75 to fill up a tank of gas. That's crazy. Not 100. It was 100 for a while back in the bad old days, but we could get there this summer. So other than food and energy, blah, 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 on balance, market-based measures of inflation have remained low, and survey measures of long-term inflation is a little change. Consistent, and again, that's partly because there's no wage inflation, so people aren't going out and spending stuff. People don't have money. Disposable income, I had a chart the other day, disposable income has dropped to like nothing. People are like almost negative in disposable income. That was a very important chart from I was this week, I think it might have been Monday's Post. Let's see if I can find that. That was a good chart. Not that. Let's see. Yeah. Real disposable personal income, minus 2%. It was negative in January too. Minus 0.2%. Flat, nothing here. Minus. Real disposable personal income. This is a bullshit number because it's based on Wall Street bonuses. The number is a total. It's not the average of people. It's not the mean or median. This is their total disposable income. So when you hand out billions of dollars of Wall Street bonuses, you inflate the thing, but it's not evenly distributed. So real people didn't get it. Once those bonuses are sucked up, all of a sudden you see what's really happening, which is people's disposable income is dropping steadily. And that to me is a much more accurate measure of inflation than looking at the prices of things. Obviously, there's inflation if people can't afford, are losing their spending power. Something is sucking up their money, right? And it is gasoline in a large part. And here you have the consumer spending. They're spending more because they're buying the things that are going up in price, like gasoline, are essential to life. They can't not buy it. And it takes a while before people, again, if you and consumer confidence was really high. So you've got people who believe things are getting better, and people believe that the economy is improving, and the economy is improving, but not for you, not for little guys. The economy is improving great for us. We're investors. It's fantastic economy for us. We're making boatloads of money, but for the people, no, not so much. And this is what they don't understand. I couldn't be happier. Everybody on TV couldn't be happier. All the people who were interviewed on the Tonight Show or the Late Show, whatever you're watching on TV, they're all happy as clams because we're the rich people. Of course we're happy. Everybody I talk to is happy. I walk around town, people are thrilled. I sit in restaurants where I'm sitting in a restaurant where the average meal price is $50. Everybody's in a great mood. I was at a steak place in Fort Lauderdale a couple of weeks ago, and Kevin was there from Shark Tank. He's ordering $1,000 bottles of wine. He's at the table next to me. He's in a great mood. Everything's fantastic. It's like, it's just crazy. And the steaks in that place are like $100. So, things are great. And that restaurant was packed and everybody's having a great time. Because there's lots and lots and lots of rich people. And it's to the point where you think everything's great. And let me tell you something. The waiters, happy people. The valet parkers at that restaurant, happy people. So I leave my house, I drive to Fort Lauderdale. So I leave my little rich area where I live. I drive to Fort Lauderdale to go to a restaurant. I go to my restaurant. Go to a car park guy who gets $5 for parking my car as a tip, and he parks 100 cars a night. I go to the restaurant where the waiter is getting the waiter must have made $100 tip off my table. And God knows what he made off of Kevin's table. So the waiter's happy, I'm happy, the people are happy, the manager of the restaurant is thrilled because everybody's eating his $100 steaks. So I'm in my little bubble. I think everything's great, and if you ask me if I'm a guest on TV, if I'm an economist or whatever, and I'm not as self-aware as I am personally, if you ask an average person who lives in the same kind of bubble, they'll tell you everything's fantastic. I meet lots and lots of people who have lots and lots of money, and they are going on vacations and doing things and spending, going places and whatever. But those people are only 10% of the people in America. Maybe 20% of the people in America are in good shape. The bottom 80% are not in good shape at all. And I'll tell you something, Joe Biden is talking to those people. And that's why his polls came out like through the roof. Because Joe Biden comes out and he's talking unions, and he's talking he's talking right to the working guys, the real actual people who he knows really well. And he's got a really good chance to beat Trump, actually, because he does understand what's going on in this country, and he's able to articulate it in a way that they understand without Trump's meanness or negativity. Biden's able to just say, hey, dude, this is America, but this is what we need to do. Let's get our country back and get it on track. That's why Biden is like flying up in the polls, because when he speaks, people are really responding, really responding. He hits it home very well. Elizabeth Warren doesn't do that. None of the other candidates really do that. But Joe Biden just comes across as a guy who actually understands where it's coming from for regular people. And this is where it's coming from. This is the reality. And I'll tell you where I see it. I take Uber a lot, so I see it with the Uber drivers. Those are the guys who are hurting. In my little bubble, and it's only because I engage all my Uber drivers in conversation, because I'm always curious. I always want to know, why are you driving Uber? What are you doing? What's your life like? What brought you to this situation, basically? Why are you a gig worker? I fly from city to city. I go to these places, and I realize like I'm living in a bubble so much. I'm in a hotel, and again, same thing. I go to a nice hotel. Everybody in the nice hotel is making money. The waiters are making money. The people are making money. The maids are making money. Everybody's happy. And it's very easy to start thinking that poverty and low wages and such are somebody else's problem. It's not really happening. But it is. We just don't go there. We just don't live there. We pass it by. These guys wash our car and don't talk to us, you know. These people are working and stocking the shelves in the well, not shopping in Walmart, but you know, when you go to the store, the people in the back who are stocking the shelves and doing the stuff, the people who are working, you know, who are killing themselves in Amazon's warehouses, they know what it's like. But we don't talk to them. You don't see these people. But that's most people. They're just invisible. And they're at a breaking point, and nobody cares, and nobody's doing anything about it. This is horrible. How can you claim to be a great country? How can you claim that you have a fantastic economy when the ordinary person is losing a 0.5% of their buying power in 1 quarter? At the end of the year, at this pace, they'll lose 2% of their buying power. Yet, and that's while they're borrowing, how much is this? 4 and 6 is 1%. They're borrowing 1% while losing 4% while losing 0.5% of their buying power in a quarter. That means in the course of the year, they'll be about 6% behind where they were last year. How long can you keep doing that to people before they revolt? How poor can poor people get? 6% poor, 12% poor, 18% poor, 24% poor. 4 years from now, they'll be 24% poor. And this is not going to stop because robots, automation, the same stuff that's making us rich is making them poor. And it's a huge problem, and it's just not being addressed, and it's very scary. Anyway, so where are we? FOMC interest rate on excess reserves cut to, I didn't see that. All right. Oh, did we even finish that thing? No, it's not really here. I mean, I guess it must be some other piece of paper that they, oh, implementation note, that must be it. So apparently they did make a very tiny cut, which you would think would make people happy. The markets are up a bit. See, popped up a little bit because apparently when you read the notes, they've got a little tiny cut there, and any kind of cut is nice, right? It's going to make people happy. See if there are any questions. Nope. Okay, good. So I'll just keep rambling on since there's no questions. All right. So I was going to see what the highlighted thingy is for the Fed. What do you call it? I forget what you call it. Euro. Fed dot plot. No, it's just a joke. It'd be nice to have actual information. Fed statement. Fed press conference. Oh, right, that's right. They're going to start talking soon. That's going to be more stuff. Strong earnings, revisions. Ah, here we go. That's what I like. That's my favorite. What is this? I think I broke it. What is? Oh, what happened? That's what I wanted to see, and it's broken. Ooh, something happened. Wow, that's weird. Apparently, since the time it first came up, they redacted it or something. Oh, here it is. All right, I'm not going to try to open this up. I'm just going to read it. So what did they do? They said labor market remains strong, no but, and economic activity rose. So before it had slowed, now it rose at a solid rate. Payroll was little changed in February, it says. They gave up on that. Job gains have been solid on average. Unemployment remained low. Before it said recent indicators point to slower growth. Now they say growth of household spending and investment has slowed. That's interesting. Recent indicators point to slower growth, and now they're saying that growth of household spending has slowed. Isn't that the same exact thing, except for different words? On a 12-month basis, overall inflation, before they said has declined due to lower energy. That's out the window, obviously. And of course, this was January. The last date was January. Actually, it was March 20th. Okay. So now they're saying inflation other than food. So before they were saying that inflation had declined, and now they're saying, well, other than food and energy, it's declined. So in other words, before they said because of food and energy, inflation declined. Now they're saying other than food and energy, inflation has declined. And you know what's going to happen is the next thing's going to be it's rising. They're basically ignoring what's actually happening. Running below 2%. On balance, market-based measures of inflation have remained low, blah, blah, blah. So they're just looking for reasons not to raise rates. No change whatsoever in this paragraph, no change in this paragraph. For some reason, they changed chairman to chair. I don't get that. I guess we're I don't know. We're now being politically correct in our designations, and that's just different. Okay, that's it. So a big nothing really, but the teeny tiny little 0.5% change in what was that? What is this? Who said this? Excess reserves cut by 0.05%, and that's all it takes. That's all you need to do to pop up the markets. It's not going to last, so I wouldn't take much into it. We're just looking for excuses to go up. Meanwhile, this is very poor performance actually because Apple is up $14. So you take 14 times about 8.5 on the Dow. So 14 times 8.5 Dow points per dollar is 119 points. So Apple alone is adding 100 points to the Dow, and the Dow is up 50 points. Now, it's adding to the S&P, it's adding to the NASDAQ. So therefore, and Apple, by the way, Apple with the NASDAQ, you just take the 7%. So basically, if Apple's 10%, if Apple's more than 10, it's more like 15% of the NASDAQ. So Apple is adding a good 1% to the NASDAQ, and the NASDAQ is up less than 1%. So what you have going on now is that people are selling everything while Apple's going up to mask the selling. People are selling other stuff. And if we have a lot of volume, I'll be very worried because that would mean they've been waiting for a chance to dump a lot of stuff into an Apple rally. So let's see volume-wise, how are we doing? Volume is very low, so it's not a big thing. But yesterday's volume is much. Look, 78,000. That's a 78 million. It's a lot higher than it's been for ages. We haven't looked at 78 million. You have to look how far back you have to go to find 78. All the way to April 1st. That's the last time we hit a number as high as it was yesterday. On the last day, the first and last days of the month were the only times we hit 70s. And keep in mind that back in the day, look at this, 140, 126, 144, those are the numbers we used to put up. This is just madness. You're talking 1/3 the volume that we had when there was a sell-off. So we've taken back the sell-off of December has been taken back on 1/3 of the up volume as it was on the way down. That's not a solid basis to rebuild a rally. Imagine, so all this is on 1/3 the volume. So, basically imagine that your wall gets knocked down and you rebuild the wall with bricks that are 1/3 the weight of the original bricks. And you say, look, we rebuilt the wall. See, look how good it looks. It's all fixed. And what's going to happen? The next time a wind comes by, it's going to knock the whole thing right over because it's not solid. You didn't build a good base. And that's why volume is important. There weren't actually that many buyers. But what happened is all the sellers left. The sellers all got their money out here. Then buyers, now there's no more sellers. So the buyers drift back in, blah, 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 blah. But as soon as people start selling again, there's not enough volume to support this. As soon as this many people want to sell, see these spikes of volume, forget that. That would be insane. As soon as these kind of levels of people want to sell, it's going to completely swamp. And these are they're hard to gauge, but this is in the 2.5 billion range. This is more like in the well, it says 2 billion, but it's not, because you can see from the buy volume, there's huge differences. It's a lot. It's a lot more than that. I'm not sure what this number actually is. But you're coming up on very weak foundations, and there aren't enough buyers to support selling if selling comes. And so far, there's been no particular reason people have been rushing to sell, but God forbid they do. And this thing is going to look what happened. You guys don't remember this because we were basically shorting the market at the time and seeing we were thrilled when it happened, but this is freaking shocking. That's just one day, boom. Here's another day, boom. Then it looks like you're recovering, and then boom, boom. Then boom, 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 boom. That was relentless. We were having a good old time because we shorted into Thanksgiving. It was like perfect. But it was horrible. And we're not prepared for that now. I'm telling you now, we are not that hedged. So we will sustain damage if this happens again. All right, I'm less worried now because you had the declining 50-day moving average. And that's what I said in Thanksgiving. Remember, we were talking about this. I said, you're going to have a death cross. There's no way it's not going to death cross. If you're having a death cross, it's a very bad signal, and it's overbought, and blah, blah, blah. And I was right, and it went down, blah, and great. Now it went back up. And that's why I've been reluctantly bullish, even though I hate it. I'm still reluctantly bullish because technically this is huge supportive. And it's going to keep being supportive until you start seeing some damage to the 50-day moving average. We're not really in danger until the S&P drops at least 100 and something points, until it gets back below 2850. It's very hard to make a case technically for any kind of danger to this thing. It would take something catastrophic for us to just fall for no reason. You need this 50-day moving average to start curving over to get some proper weakness in the market. And we're nowhere near that. So so again, as I said in the review yesterday, I don't know if anyone pays attention when I make a post in the middle of the day, but it wasn't the middle of the day, it was last night. Look how hard I work for you guys, right? As I said in the middle of the post, not today. I want to liquidate, but not today because I can't liquidate on this chart. I haven't got a good enough reason. I haven't got a newsworthy reason to liquidate on a rising 50-day moving average and a rising 200-day moving average. Even the 200 is rising a little bit. This is going up clearly, right? Not fast, but it's going up. And this is going up. And until this flattens out and starts curving down, and until you start seeing this, there's no reason to go freak out about anything. So outside of some astounding event, we're just going to have to wait and see what happens. The Fed's and Powell's about to have his conference. He's going to say how great everything is, probably. It's his general things. He says how great everything is. So it's funny. I mean, I wish I didn't love our position so much. I wish a couple of things. I wish I didn't love my position so much, but I do. I picked them very carefully. I think they're fantastic. They've been performing fantastic, so I'm not delusional. They're pretty damn good, other than Frontier, which has been a disaster. I'm very happy with what we got. How is Frontier? Are they still down? Like they were down massively before. FTR. I just mentioned them yesterday on that show too. Like Frontier is great. FTR 214. That's basically right at our. That's our net price. So it's not. I mean, I'm not happy with that. We don't want it to be our net price, but we'll see. I mean, we're going to be sitting on that for many years, I think. Anyway. Generally, oh well, here's Helios and Matheson, another wipeout, right? So we have 2 wipeouts so far. These are all short puts on the. I mean, this is crazy. Every single stock we picked, except CAH, which is still over the put. The put's a 45 put, and this is a 48. So it's just a vagary of the volatility, but it's still actually a very good pick. Every single one, there's 19 out of 20 winners. And don't forget, we cashed in a lot of other winners. We didn't cash out any losers, we only cashed in winners. 19 out of 20 remaining winners. The ones that were losers have turned into winners on the short put side. All right. I wouldn't say I'm a genius. I'm gonna say look at the variety of things that there shouldn't be 2 of these. This is weird. Oh no, I guess there should be. We did that twice. Okay. I mean, Apple, Ally Financial, Broadcom, Best Buy, or Best Beyond, CH, Caterpillar. There's quite the variety. CVS. DK Sports, eBay, MetLife. It's a hell of a nice variety of things. It's things that happen to be cheap at a certain time that I thought were good. And even Sony's doing well, which is, that was one we picked a while ago. How do you lose when 19 out of 20 things you pick work? And how much is this game? I'm just going to eyeball 10, 12, 20, 22, 24, 25, 26, 27, 28, 31, adds up fast, right? Here's 2 more, 33, 35, 38, 5, 39, 4, 40, 46, 7, 8, 40, about $48,000, almost $50,000 in profit on short puts. That's in a $500,000 portfolio that we started last year, 10% profit just from selling short puts. It's ridiculous. It's not normal. Nothing went bad. None of these stocks went down. Nobody's got a problem. That's crazy. And most of these aren't even that old. November, May, July, September. I mean, this is not even a year. All these guys are from the second half, pretty much. Couple of first halves here. That one's, oh no, 128.19. That's from recent 19s. These are all 19s. These are like brand new. So we're not even talking about taking a year to make $50,000. And that again, it's, we were talking yesterday on the radio. It's not a complicated strategy. I didn't want to get to the puts because I didn't want to freak people out, and there was another guest there, so I want to like monopolize the show. But I like that guy too. He's cool. He's an Australian a doctor, but he's like really into like the body and the balance of the body systems and all that. It's really cool. And then he like consults like top-notch golfers and things on health and fitness. It's really cool. And he made the coolest comment about the Olympics, about like how it was a great observation. He's like, Australia only has like 20 million people, and when they have an Olympic athlete, it's rare to have somebody who can compete on the world stage at that level. Compared to America with 300 million people, we have 10 times more people who are qualified at the world stage level. They have 1/10 as many people who are good at it than we do. And they have to we both have to fill the same sized Olympic teams. So he says, which made a great point, he's like, you guys push your athletes a certain way, and if they get injured, your attitude of the coaches and whatever is, we'll just get another one. If we break one, we'll get another one. He's like, we can't do that. We don't have that luxury. If we're lucky enough in Australia to have somebody who's that good, we need them to be able to compete in 3 or 4 Olympics. We need them to be good for 16 years. So we have to teach them how to train without hurting themselves. We have to teach them how to perform at their peak without damaging their bodies, because we need them again. We can't have, America is very much one and done with Olympics. It's not that rare that people only compete in 1 or 2 Olympics in America, because we don't give a shit whether or not they make it through life. It's because we're going to get a new batch of athletes next year. There's going to be another bunch of people who can compete. I remember I had a girlfriend who was on the Olympic swimming team many years ago, and that was the year they boycotted. She made the Olympic swimming team, but we boycotted it. It was the Moscow Olympics, like in 1980 or something like that. And she was like, that was my shot. She did not expect 4 years later to get another chance to swim, because that's the way they are in American athletics. It's like they take you at your exact peak, and once you pass your exact peak of fitness and whatever, boom, they're done with you. And she was so, you could imagine how heartbroken she was to train her whole life for this thing and to make it and to qualify for the Olympics, and then America goes, oh, we're boycotting. We're not going to go. What a disaster. So where was I? Anyway, so this is weird. Okay, this is ridiculous. We made $50,000 in I'd say things that are probably an average of 6 months old. So that means we can make $100,000 a year just selling short puts. That's not normal. 100,000 is 20% of our freaking portfolio selling short puts. That's just like too much. Okay. This is what's wrong with it. It bothers me. It should bother you too. It's like, if you every time you went home, there's a guy standing at the foot of your driveway handing you $100 bill, and every day he's there and he gives you $100 bill. He gives you $100 bill. Okay, so you don't know why he's giving it to you. You don't mind getting $100 bill, but don't you start at some point you got to be suspicious and think about what's going on and where is this money coming from, and is it going to end, and so on and so forth. That's how you should be thinking about this. You should not be getting money handed to you like this. It's ridiculous. Where is this money coming from? Where is this wealth being created? Who's got it? It's not. That's the problem. There's not this great surge of new money that's been invented. Now, accordingly, they went down a bit, so they're hurting. So we'll see what happens with these guys. Still, I like them. Armor, these are our dividend stocks. Oh, and our dividend stocks paid so much money. I was looking at those dividends. We made so much money in dividends. Another like $30,000, $40,000 in dividends over the course of the year. It's just like, it seems like nothing, but when it's like, 50,000 here, 30,000 here, that's just side money compared to the gains you get. And again, if you look at these stocks, they're generally up. Except Tangier is not doing too good, but generally they're up. And we're collecting the dividends. It's a great way to park cash, and that's what I'm talking about, by the way. When I say you take $500,000 and make it safe, this is what I call making $500,000 safe. You put it into simple spreads like this on dividend-paying stocks. They're not going to make a lot of money, but they're going to pay you 10% a year. It's not complicated. Now, then we've got our stocks. How much do we like these things? I went over this in the review, so I'm not going to do it again here. But, I love Apple. I love Alaska Air. I like Vertex or whatever they're called. Citibank, Cheesecake Factory, Celgene. We know Celgene is being bought out. That's a no-brainer. Why would I do anything here? They're being bought for $100. That's free money. Chipotle is our messy trade, but it's even. Chipotle's a messy trade, but it'll eventually pay off. What's that short call? 600 short calls, and they're at 700 again. But we're going to roll this. We're going to double it, whatever. Caesar's fine, Delta fine, Disney obviously great, Ford great. And again, winner. It's like Frontier. It's Frontier taking a lot of money. Gilead. I mean, look at these numbers. Up. ABX not up, but I like ABX a lot. GoPro. I think I could cut GoPro and wouldn't cry about it, but still it's right on track. There's no reason to cut it, but it just it's funny because they were really hurting for a while, and we ended up with a $3 calls deep in the money, and they're already at $6, so that's great. Goldman Sachs obviously is always going to make money. Haynes is fantastic, makes up for LB, which is not so fantastic. Even LB though came back, right? Can make some money. IBM stock of the year, no problem. So what am I going to get rid of? IMAX, obviously, just had a blowout weekend with the Avengers. That, by the way, if you ever had doubts about this IMAX trade, that Avengers movie certainly put that to rest. They were completely sold out. Every single show, could not get a ticket. They're running from 6 in the morning till midnight every day. And people are paying whatever the frick it costs to buy IMAX seats. There was not a single IMAX seat available. We had to see the Avengers in a regular theater. It wasn't regular. I had cool seats that like rumbled. Like the seats had vibrated and stuff when things happened. It was amazing. It was like a cool theater, but it wasn't IMAX. So just couldn't get it. By the way, they show. That's the other cool thing. The Avengers movie, the greatest selling movie of all time, shot entirely in IMAX. All IMAX cameras, making it a very expensive production, but completely paid off. Everyone was thrilled. Didn't have that Game of Thrones see in the dark battle problem. It was fantastic. So, that's a huge boost for IMAX too. If that becomes a thing, if people say, oh my God, you get a payback for shooting these movies in IMAX, and their box office was blowout, so I love this trade of IMAX, and we're pretty aggressive on these guys. And they finally popped through where we wanted them to be, but I'm going to have to sell a few more covers. International Paper, Kraft Heinz is doing poorly, but I like him for the long term. LB Macy's, I like for the long term, not doing good so far. MJ, as I said yesterday in the thing, easy money. Philip Morris, easy money. Mittal Steel, once they do the trade deal, that's going to be huge. And you, great money. Annalise, good dividend pay. New York Community Bank, good dividend paying. Papa John's, I don't know why we still have that. I think I said to sell it because I'm sick of them. Qualcomm, Jesus Christ. The We bought back because when we started out with the calls. We bought back the short calls because they did poorly at first, and we opened it up, and now we're up 252% on our long calls, which is fantastic. Skechers, nothing wrong with them. SunPower, State Street Bank is not doing so good so far, but no, I mean, no reason I wouldn't stick with them. AT&T, of course, obviously is always good. Target's always good. THC, it's not that exciting. UCT came down a bit. Wolverine's Boots is still languishing. Whirlpool, massive gains, ridiculous, way past our target. And Wheaton Precious Metals also still holding up nicely. So what am I going to sell? This is the problem I have every time I review the freaking portfolios. How can we say it's hard to sell when everything is great? And it just bothers me that everything's great. It's too great. There's got to be a reckoning at some point. We have to normalize. We have to get back to that normal 8% growth. And like I said, we're 2 years ahead. We are 16% ahead of normal growth. So I think that given the course of this year, and there should be a correction, I think that a 10% correction in the near future is most likely what's going to happen to bring us in line. I'm not expecting a huge correction. I'm expecting a 10% correction, and it won't be a big deal if we have to ride it out, but it would be a wonderful thing if we could time it right and protect ourselves. But we'll see. Okay, I'm not going to count on it. And meanwhile, while we're doing this, the Dow turned negative because Powell is talking about weak global growth, Brexit, and trade risks. He said all of those things at the same time. So, but nothing serious. I mean, it's just a little bit of see, it's already recovering. He said bad words. The market, all he has to do is say something. That's what's scary. All he has to do is talk about some risk factors, and we went from 650 to 550. The Dow dropped 100 points in 10 seconds because he says weak global growth, Brexit, and whatever the hell the other thing was, and trade wars. The same crap we're worried about. But again, all those things, not all those things, that's a weak global growth is not a self-inflicted wound, but it's in large part being caused by the trade wars and the Brexit. And if we can resolve those things and move ahead, things are going to look a lot better. Oh, speaking of silver, look what happened. Metals really came down. Copper got crushed today, too. Don't know why. Oh, the dollar. Look at the dollar. So whatever Powell said, strengthen the dollar, knock silver and gold down. And 1450, don't forget, is where we like to buy silver. We love silver down to 1450. These are both, we're getting a very good entry point here that we haven't had in a while. In fact, let's take a look at silver. My last thing I'm doing, unless there's a question. Nope, no real questions. Chart futures, silver, metals. Yeah, 1450, but beware, we can go lower. And what you want to do with silver is if we get to 1450, that's where we like to go long. But if we fail 1450, you don't know where the bottom is. You got to get out. So you're going to play 1450. Hopefully it's going to bounce. If we go below 1450, you cut it off. Don't be a hero. You cut it off. Wait till we go back over 1450 and try again. And if it gets to 14, though, that's where I would have some serious conviction. And there's no real difference between silver and gold, except gold is higher in the channel. So I don't want to play gold here because silver is relatively here compared to gold. So I think it's an overreaction to the downside. Powell says asset prices are not extremely elevated, which is basically what I just said. So he's agreeing with me. So neither one of us is terribly worried. But you just got to, but again, it's like, it's just too house of cardsy for me when a little mention of something bad and the market freaks out. You know, it's like, you should know this. If you're a trader, you should know these are problems. It shouldn't shock you when the Fed chairman says something about it. So we'll see what happens. But all right, I think I'm done. I think I've said enough things right now. And see, Tim said, how are we liking silver? And he says, aha, you just answered it. I was right on the ball there. Can't do better than that. So I think I'm going to exit on that cue. Anyway, thanks a lot for listening, everybody. And we'll do it again next week. All right. Thanks for coming. Have a good day.